Welcome to Part 2, Cash Secured Put Sections 2.02 2.9. From the book Smart Investing, Made Easy by Steve Goldendale, How to Generate 15 to 30% Returns with the Options Wheel Strategy. A step-by-step guide to create a steady income stream month after month. In this session, we'll guide you through the cash secured put process, using clear visuals, real-life examples, and easy checklists to make this strategy accessible for everyone. Let's start with several terms and abbreviations used in the flowchart. You may need to refer back to this table as you work through the strategy. Feel free to pause and rewind if necessary. Be familiar with the terms like CSP for cash secured put, IV for implied volatility, candlestick chart, Bollinger Band indicators, etc. The cash secured put flowchart starts with the first step of identifying a stock with implied volatility of 40% or higher, then using a 12-month daily chart set up with a Bollinger Band indicator. The primary goal of a cash secured put is to generate cash. Wait, before we go on any further, let me give you a real-life example. Let's say your friend owns a gold coin. He thinks it is worth $1,000. You told him that you would be interested in buying his gold coin for $900. If he can't find a buyer in 30 days, in return for your commitment, he has to pay you $30 now. The gold coin represents the underlying stock. The current perceived value of $1,000 is analogous to the current market price. Your offer to buy at $900 in 30 days is similar to the strike price of a put option. The $30 payment now is equivalent to the option premium. The 30-day period represents the option's expiration date. If the coin's value stays above $900, your friend keeps the coin and you keep the $30. If the coin's value drops below $900, your friend can sell it to you for $900, effectively limiting his loss. Now you may ask, where do I find these stocks with at least 40% implied volatility? You could start with the 10 largest U.S. corporations listed here. Keep in mind that each company's implied volatility could change every day. The next question you may ask is, why choose 40% implied volatility? The answer is quite straightforward. Higher IV generally means higher premium. The 40% IV recommendation is simply a guideline to help you get started. Of course, you can select a stock with a much higher IV than 40%, but it also carries a much greater risk. Remember, your number one investment objective should be to avoid losses. For the following example, we are going to use NVIDIA, ticker symbol NVDA, with 52.27% implied volatility. First, set up a 12-month daily candlestick stock chart with the Bollinger Band indicator. It shows a moving average line in the middle. The upper band is normally set at 2 standard deviations above the moving average, and the lower band is normally set at 2 standard deviations below the moving average. Wait till your stock is in the sell zone. Sell zone is the area when the stock closes below the middle 20-day moving average line and above the lower Bollinger Band. On September 24, 2024, NVIDIA closed at $108, lower than the middle moving average line of $118.39. Now, on your trading platform, navigate to the option chain. The exact path may vary depending on your platform. Open the option chain for an expiration date 30 to 45 days out. For this example, it's October 18, 2024. Focus on monthly options, as they have higher liquidity than weekly options. Next, in the option chain table, locate the puts heading. Under the delta column in the puts section, look for a value of -0.30 or less. Find the corresponding strike price for this delta value. In this case, it's $98. Note the bid and ask prices. The bid is $3.75 and the ask is $3.85. Use the average of $3.80 as your target. Premium you'll receive for selling one option representing 100 shares is $380. Compare the strike price of $98 to the current stock price of $108. If the stock is at $108 and you are selling a put at $98, you are hoping the stock stays above $98 at expiration, so you keep the full premium. Now that you've chosen to sell the put option at a $98 strike price, you can visualize this price as a secondary defense against stock decline. In other words, the stock can drop by another $10 or 9.3% without causing you a loss. With this cash secured put strategy, you have 3 out of 4 ways to win. First, when the stock price goes above the strike price of $98 at expiration, you win. The put option expires worthless, and you keep the premium. Second, If the stock goes sideways and closes above the strike price of $98 at expiration, you win. The put option expires worthless, and you keep the premium. Third, if the stock price goes down but is still above the strike price of $98 at expiration, you win. The put option expires worthless, and you keep the premium. The only time that you would have a loss is when the stock closes down below the strike price. If the stock price falls below the strike price of $98, you'll be assigned the stock, meaning you must purchase it at the $98 strike price. For example, if the stock drops to $90 and you collected a $3 premium, your net cost per share to purchase the stock is $95. Your unrealized loss would then be $5 per share. Before you jump in and place that order, let's do a quick checklist. Item 1 and 2, revenues and EPS, earnings per share. Visit https://finance.yahoo.com. Enter ticker symbol NVDA in the search bar. Click Profile in the left sidebar. Then click Financials in the left sidebar. Check if revenues for the past few fiscal years increased year over year. And basic EPS earnings per share is positive and also increased year over year. Item 3, uptrend. When reviewing the 12-month stock chart, look for an overall upward trend in the stock you've selected. You're aiming to profit when the stock price increases. It's generally unwise to bet against the overall market trend. Item 4, sell zone. Confirm that the body of the candlestick is below the 20-day moving average. Item 5, implied volatility. Verify the stock meets the over 40% IV threshold. Item 6, expiration. Ensure you've selected an option with 30 to 45 days until expiration. Item 7, delta. Check that you've chosen an option with a delta of -0.30 or less. Item 8, monthly options. Confirm you're using monthly options, not weekly, for better liquidity. Item 9, make sure the bid and ask price is reasonable. Item 10, use STO sell to open order when entering your order to sell a put option. Item 11 and 12, check for any breaking news and review after market hours and pre-market activity. Make adjustments to your order if necessary. Now, you are ready to place your order. Take your time and make sure every step is correct. Review order status after you place your order. On expiration day, October 18, 2024, NVIDIA closed at $138 above the strike price of $98. Here's what happened to your account. Your put options expired worthless. You keep the entire $760 premium, collected on September 3, 2024. No further action is required. You can restart the process by selling the put options again. You may ask, what happens if the stock closes below the strike price of $98? If that happens, you are obligated to buy the stock at the strike price of $98. $19,600 will be deducted from your brokerage account. You now own 200 shares of the stock. You can then implement the second part of the options wheel strategy by selling covered calls on your newly acquired shares. Details of this topic will be covered on part 3 of this video series. If you're interested in learning more on covered calls, subscribe and join us in part 3. Check out this book on Amazon, available now.